what's happening now is, in order to keep this all going, companies like NVIDIA and AMD are now agreeing to make deals with OpenAI to give them money. But what's interesting is, so NVIDIA gives OpenAI $100 billion. OpenAI turns around and gives the money right back to NVIDIA to buy the chips. That, to your point, is exactly what we saw in 99 and 2000. And we called it revenue round tripping.
Welcome back to Quarter Over Quarter. I'm your host, Don Drury, president of Moran Wealth Management. We're glad you're here. We've got some really meaty topics to cover today. I'm joined by my co-host, my good friend, Tom Moran, CEO, CIO, founder, all-around great guy.
Well, thank you, Don.
And today we're going to talk about fourth quarter and kind of what's going on in the markets. What are some important considerations? How should you be thinking about the end of the year, maybe changes within your portfolio, and just thematically what's going on around the globe? And we're joined by Tyler Hardt, CFA. I like to refer to him as Dr. Doom. We'll find out if he is positive or negative. But Tyler, thanks for joining us.
Well, thank you for inviting me, and I'm excited to finally be invited onto Quarter Over Quarter and join you fine gentlemen to discuss the markets.
Thanks for being with us. Tyler, you are a fundamental portfolio manager, and I think meaning you pick up rocks, you look under them, you really do a tremendous amount of research. Tom and I are always amazed that you are a bit of a savant in being able to just spout off anything about any company in the market in general. So you are a fantastic resident expert to kind of give us a perspective. So let's talk about how third quarter wrapped up. What were some of the themes that you think are going to carry over into fourth quarter? And what are some things that are on the horizon that perhaps we should be paying some attention to? Anything else?
No, I want to hear Tyler's perspective on things that he might be concerned about that over the next couple quarters.
Perfect. And then I need you to keep him honest.
We agree on a lot more than we disagree on, so that might be your job, Don.
Okay.
I'm a little more concerned about the current state of the market right now, and so I think Tyler. So I think you need to be the more optimistic one. You could be the.
I can be the Tom Lee of the crowd, the Perma Bull. Fantastic. So, Tyler, take it away.
The quarter actually turned out to be quite strong. And so when you look back at what we saw in the third quarter, both fundamentally across a lot of stocks and with just the overall performance that we saw out of particularly AI tech names, we saw a lot of froth come back into the market. We saw that despite some of the divergence that you've seen, that you've heard about with this K-shaped economy, you've seen that in the underlying companies. So when we look at the companies that are more industrial focused, when we look at the transportation companies, when we look at companies that are in manufacturing industrials, they actually perform the week outside of the AI area. So what we do is we like talking to the management teams and listening to them. And that's where we kind of get our economic data from, really from the ground, as you said, as you alluded to, from the bottoms up approach that we employ. And then conversely, we heard really good things from the tech space. We heard good things from the data center. Anyone doing anything with a data center, they are booked through the next 2 years. Utilities, energy, that's where people are realizing that's what we require. And so you're seeing a lot of excitement about that. You're seeing a lot of excitement about nuclear, a renaissance there. And just looking back at the quarter, it was surprising how well it went because there was a lot of people who were concerned coming into it, right? So there was a lot of, oh, hey, September and August, they've been bad months. We're already out to a strong start for the year. Some of the economic data, the headline data is coming in a little negative, but there really wasn't this surprise. I think people were waiting for a surprise and it didn't happen. The market continued to move forward. And I think it moved forward on that euphoria. Now, we've also seen some credit card data from some of the banks that we get. And the surprise that I saw actually this morning was from Key Bank put out their survey on that. And we actually saw an acceleration in the consumer spend. Now, it was K-shaped again. So the top end is doing well. So the top end consumer is doing remarkably well. And the lower end is still struggling. So we're seeing that when we talk to companies. We're seeing that in the economic data as it splits. But those are the things right now. I would say overall, Q3 came in much better than expected. The euphoria is creeping back into the market, which should make you cautious. But at the same time, there's also a lot of opportunities. So when we look out there, we look at international stocks, we look at natural resources stocks. It's becoming clear now that as the value of the dollar has continued to go down this year, and we're down about 12 to 15% on a year-to-date basis, you're seeing de-dollarization. You're seeing more moves in the gold. Gold, interestingly enough, was one of the strongest performers in the quarter, where there was, people were saying they're concerned, but gold was the best performer. And similarly, on the other end of the spectrum, we saw IT being the best performer. So it really is this divergence of the economy and the markets that we saw this quarter.
And we see some positive things. We're going to season the fourth quarter is normally the best quarter. We have, we have momentum going into the fourth quarter, which usually should carry through. We've seen some retail sales, certainly on the high end, has been. But what concerns me, and give me your perspective on, 75% of the return of the market this year has been AI-related stocks. 85% has been of the earnings growth has been AI-related stocks, and 95% of the capital expenditures have been in the AI space. That sounds like a bubble to me. What's your perspective on that?
Yeah, so from our perspective, when we look at the end of the day, there has to be a return on investment. And we're seeing massive investment of a scale that, quite frankly, I haven't seen since 99, 2000 with telecom and the internet build out. It's very reminiscent of that. In fact, that spend is, we still haven't even caught that yet. So if you look at from an economic perspective, the internet build out was about 2.5% of GDP in the final year in the year 2000. Similarly, whenever there's new technology, whether you go back to railroads or canals, you see the same thing. Railroad spending got to about 4% of GDP in the 1830s when it was at its peak. So we're right now, AI is about 1.5% of GDP. So that theoretically, there is still room for it to, to continue to expand. But when we look at it and you say, okay, let's step back for a second. Right now, we are on pace to spend about $360 billion in capital investment just from the hyperscalers. So that's Google, Meta, Microsoft, Amazon. We can throw Oracle into that group now because with their deal with OpenAI. So let's just call it $400 billion in spending coming amongst friends. They need to make a return on that investment, right? And not only that, but if you think just from a depreciation perspective, if half of that is chips and you have to replace those every 3 years, you're looking at, $80 billion right there that you need to find in some kind of, in earnings. And so if you have that kind of earnings, you need revenues. And so even if you just look for revenues of 80 billion a year, we're not seeing it. So OpenAI is supposed to do about 14 billion in revenues this year. Google's a little bit higher on that end. They're closer to $20 billion in that space. But when you go through it all, the revenue is not lining up with the capital investment. And at some point, there's going to be a need to realize a return on that investment. And that's where we see the bubble. We view a chance somewhere out in the future, whether it's 6 months from now, a year from now, 2 years from now, if revenue does not start ramping rapidly, we will likely see a decline in spending around AI infrastructure. And that is what we think is more concerning because the rest of the economy, as we talked about, and as you said, is weak. So if AI, as the stronger point of the economy, begins to slow down, this could drag down the entire economy if the rest of the economy doesn't accelerate out of it, which could happen.
Now, tech represents 36% of the S&P now. The peak in 2000 was about 34%. The valuations are not quite as high as they were at PE, but still much higher than normal. It just, the entire market really is tech driven. So I would think at some point, if they're not making earnings on these capital expenditures, it's going to start to show up in earnings. Then we got earnings season starts next week with the banks. People say, they show me the Netscape chart. Oh, look at Netscape had another 2 years to run, and this thing is just the infancy. But I don't know this as AI is as transformative. We love AI. We're using AI. We're almost all our software is AI related. So we're benefiting from the efficiency. But I'm not sure the AI companies are as profitable as they need to be. And I'm worried about this, where they're investing in AI companies. They're spending so much money, so AI companies go buy more chips. There seems to be some circular argument to that I worry that it's the same type of euphoria that we saw at peak in late 99, 2000.
And Tyler, you and I were chatting about this, and something that you brought up that I thought was really interesting. Numbers are going to be artificial due to how much depreciation is creeping in. Kind of talk about that, because I don't think everyone's focusing there.
Yeah, so let's just look at Google. So Google, this year, they'll do about $115 billion in operating cash flow. And when you look at their depreciation line, it's been hovering around $17 billion, and it's moving up. However, they're spending $60 billion on capital investment. Now, that capital investment ultimately will work its way into depreciation. So when we look at an underlying company, a lot of times we actually normalize the earnings power for over-earning or under-earning in depreciation. So, for example, the railroads, they spend more on on capital investment every year than they do in depreciation, because a lot of the rail lines have been sitting there for 50, 100 years. They're fully depreciated. So the earnings is actually less than you think, because you have to use a higher number for depreciation. Similarly with Google here, if they continue to spend at a $60 billion pace, depreciation is going to go to $60 billion. And if you do that, all of a sudden your earnings just got cut in half. Right, so your earnings power, what you may thought you're making, you think you're making $15 on Google in earnings power, and it turns out, well, if you use the capital investment instead of depreciation, and you start depreciation and all assuming they go forward, well, all of a sudden your earnings is 7, and then that multiple, which you thought was attractive at 25 times, is all of a sudden 50 times. And so that's the thing that we worry about when we look through this, is a lot of them have changed their depreciation schedule. So Amazon, Microsoft, Google, they've all recently changed how they're depreciating their data center assets. So for example, the GPUs have gone from, what they were depreciation of 4 years to 5 years and 6 years. And as they do this, it lowers the current depreciation expense, making current income look better despite the fact that they're spending this money. So it's something we watch, it's something we track. And at some point in the future, if they continue to spend at this pace, they need to see higher operating cash flow. Otherwise, their earnings will decrease at a rapid rate. Oracle, in particular, is already they've been the most aggressive in this stance, and not only that, but they actually have been funding this through debt. So when you look at Google, you look at Amazon, they've been cash flow machines, and so most of this investment is still coming out of operating cash flow. Whereas in the case of Oracle, which, as you know, signed a $300 billion with AI, coming back to your circular reference discussion, they're going to go cash flow negative significantly in order to fund that. And so we don't think that's being appreciated in the market. And in fact, when we saw the stock price jump that much, we were really surprised by it, because yes, they announced a $300 billion with OpenAI. However, OpenAI doesn't have $300 billion to give them. And so we don't know where that money is coming from. And that gets to the circular reference. You're seeing a lot of deals all of a sudden where people are throwing around significant numbers, whether, Meta, when he was meeting at the White House, Zuckerberg talked about $600 billion of spending. Elon for XAI is talking about 200, 300. And then, of course, the most aggressive out there is Sam Altman with OpenAI, and he's demanding about $1 trillion of investment. I don't know where he gets the money from, because currently he's on pace to do $14 billion in revenue. And so what's happening now is, in order to keep this all going, companies like NVIDIA and AMD are now agreeing to make deals with OpenAI to give them money. But what's interesting is, so NVIDIA gives OpenAI $100 billion. OpenAI turns around and gives the money right back to NVIDIA to buy the chips. That, to your point, is exactly what we saw in 99 and 2000. And back then we called it revenue round tripping. You saw that with all the people building out the fiber. So we saw that at WorldCom. You saw that at Enron. I mean, those are not names you want to be associated with in my mind. So it is a worry of ours. We are watching it. If there is a bubble, the bubble is quite simply in the fact of this investment can't happen because there's no underlying support, and then it slows down.
We've talked a lot about AI. We've talked a lot about tech. It's a big world out there. There are a lot of companies that are producing, have great revenue, great business models. Where are some of the opportunities that you see value today?
We see a lot of opportunity in healthcare recently, and healthcare is interesting because it's a more defensive part of the market. So it's, if you do get worried about the market, it's a place you can go look for investment ideas. And in particular, we've seen some of the major players. So we've seen United Healthcare, we've seen Elevance, we've seen Humana. Some of the big insurance companies have gone down substantially. And what's interesting is some of these have been cut in half in the last over the summer months, and they all have different stories behind them. So some of them do not have the issue. So United Healthcare appears to have some real issues. And they're working through those, and that stock is down about 50%. But similarly, their largest competitor, Elevance, isn't showing many of the same issues. There's no investigations around Medicare billing issues. It's really just an issue. It's their particular problem is that they misinterpreted the spending for Medicare recipients, right? So Medicare recipients are using more healthcare than they planned for. And so, but that gets redone every year. You can change your rates every single year. And so Elevance, in our mind, created a huge opportunity to go buy that, where it had been cut in half. Their business is going to get stronger with what's happening with United Healthcare. They get to reprice the risk, and you can buy a company at 10 times earnings that usually trades for 16 to 18, and deservedly so. So we see opportunities there. Right now, we see a lot of, if you want to take a contrarian bet, we see a lot of opportunity in energy stocks. Natural gas related stocks, just to put this in an example, natural gas is currently selling for about $3.50. That's near its lows. When you look at the average price for natural gas over the last decade, it's been about $5. If you look at it on a oil equivalent basis, which is 6 to 1, with oil at $60, natural gas should be 10. So outside of the United States, natural gas does trade for $10 a BTU. So we think there's a lot of opportunity there. And not only that, but we're seeing tremendous demand for natural gas. So all these AI plants, they're all running on natural gas peakers. So they are actually building natural gas plants at the site of the data centers. So all of a sudden you have the substantial demand for energy, most of which is being served through natural gas. Additionally, the United States has been building what we call LNG export facilities, where that's where they take natural gas that they come out of the U.S. shales, they liquefy it, and we send it around the globe. Well, with these facilities coming on, it's also another source of demand for natural gas. So the United States, we expect natural gas prices to do very well over the next several years. So we've invested in that. We've invested in companies that have exposure there. And then oil, we see a similar story. We see an environment where when we look around the world, oil inventories are around multi-year lows. Spare capacity from OPEC and the Middle Eastern countries is getting thinner by the day. We continue to see demand coming from all parts of the world, particularly emerging markets. So India, Africa, China, we continue to see more oil demand. And as that goes up, and U.S. shale, which has met the incremental demand growth of the last decade, is no longer growing, and people look around and see low inventories, we would not be surprised to see oil stocks in the next year, 2 years, do what we've seen the gold stocks do the last decade, or the last few years at least. So one of the things we do as contrarian investors is we look around for narratives that are wrong, or that we perceive to be wrong, and then we make bets around those, particularly if they're out of favor. So gold miners a year ago were significantly out of favor, but we saw the gold price going up, and we saw the cost to mine we're staying flat, and in some cases going down. and those stocks have performed very well. They were hated. There was a joke that you just bought gold directly through GLD or an ETF of some sort versus buying the miners because the miners just didn't work. Well, that has now stopped. The miners have worked. We own Barrick Mining in our concentrated value fund, and it's done extraordinarily well. It's been one of our better performers this year. So usually we look for things that get out of favor, whether it's, Google 3 years ago when they would not be able to do AI and we bought some. We've also do have some exposure to AI in the portfolio too, where we see waves of realization of what's needed next. So once the first LLMs came out with ChatGPT, we saw the GPUs killed it. We saw everyone started buying NVIDIA. They realized it right away. And then everyone realized that they needed energy and that they wanted to have nuclear power. So the nuclear stocks did really well. And now what you're realizing is the next step, agentic AI, it's going to need a bunch of memory and it's going to need a bunch of storage. And so all of a sudden, now you're seeing companies like Micron, which we own, do really well. And even some old companies that got left in the dust, Seagate, stocks that do data storage, they're doing remarkably well. Some of these things are up 100%, since April. So we look for things that are out of favor, and that's where we like to invest with the view of we have 2 years to presumably be right, and we should compound at higher rates in the market.
A lot of the stocks doing well are stocks that are not profitable and or have very short interest. I mean, is that being contrarian? Does it mean betting against that we see a return to more fundamentally valued companies that are profitable and are selling at reasonable? Do we see a rotation from this exclusively tech rally to where more traditional fundamental analysis might start to do better?
We do have some similarities with right now, the market today that we saw in late 2021. And to your point, what you're really seeing is markers of investor euphoria, particularly from the retail traders. In 21, you go back and look at that, we saw a boom in SPACs, which are basically companies that they go public and they just have money. And the idea is they're going to buy a private company. So you don't even know what you're buying, but you can invest through an IPO in a company with just basically a pool of cash. So if you think about it, that's one of the more speculative things you can do. You also saw the same thing with the profitless tech companies do remarkably well. You also saw things like Bitcoin and cryptos do remarkably well. Remember, like 3 years ago, we were all talking about NFPs and all these amazing things that were new. Well, I haven't heard anyone say NFP in about 2 or 3 years now. And so right now we're in a similar situation where you're seeing clear signs of euphoria in the markets. I like to look at IPOs as how do they do on their first day? And if you look right now, so far the IPOs year to date, the average up day is somewhere around 30%, which is on par with what we saw in both 1999, 2000, and then even a little bit even more than we saw in 21. So back in 21, that number was still pretty elevated in the high 20s. But we are now seeing indicators, to your point, whether it's profitless tech companies, we're seeing it around the quantum computer companies, which a lot of these have no prospects for 5, 6, 7, 8 years, no business for 5, 6, 7, 8 years. People are buying them. We're seeing crypto start to do well again, and it's expanding beyond Bitcoin. So we're seeing some of the more speculative crypto coins do quite well. And that just tells us that there's a lot of liquidity in the market and there's a lot of retail traders. When you look at who's buying and selling stocks, Bank of America puts out excellent surveys on this. And you're seeing most of the buying is coming from retail. Institutions are actually net sellers of stocks. So what will be interesting to follow is, if that slows down and goes away, the retail folks slip into value like we saw in 22. Because we saw a rotation in 22 where value did very well relative to the growth. And if you do see the euphoria back off, I would suspect that value-oriented stocks and some of the areas that have been left behind will do quite well as people look for profits and they look for quality companies again.
When do you think we hit this earnings cliff? Is it going to be this coming quarter, a couple quarters out? Momentum markets are the hardest markets for fundamental analysts because the momentum always goes longer than you think it's going to go, the euphoria. But when it ends badly, and you see having gone through the crash of 0102, where your tech stock dropped 72%, I think we have better companies now, but I do believe at some point we're going to hit that cliff. How many quarters do you think we're away from profitability? Reality will set in.
It's difficult. And if you think back to 2000, and you think back to that March when we peaked out, it was like, I think it was March 3rd of 2000. No one rang a bell. And the interesting thing was what we saw we saw the more speculative companies just start falling immediately back then. But the big companies that were kind of leading that charge. So think about Qualcomm back then, Microsoft, and obviously Cisco. Cisco is very reminiscent in my mind of NVIDIA. And Cisco didn't miss earnings into October of that year, of 2000. So it was almost 8 months later, 6 months later. And so what I'd be looking for is with NVIDIA. And NVIDIA, in my mind, is they're the big kahuna. They're selling GPUs for $60,000 a pop. These things used to be $5,000 a pop. And not only that, but people are looking for alternatives. So Microsoft is building their own in-house ASIC chips. Google is doing the same. Amazon is doing the same. And they're doing that because they can make the same kind of chip in-house for 30 to 40% of the cost of a GPU from NVIDIA. We're seeing the same thing with the AMD deal the other day. So people are looking for alternatives to NVIDIA. And that is probably also why NVIDIA is signing some of these deals where they're taking $100 billion to give to their clients to fund their own chips, which, by the way, NVIDIA doesn't have $100 billion. So they're going to have to raise debt to do that deal if they ultimately do it, or whatever the pace is that they've made, the arrangement they've made with OpenAI. But I look to NVIDIA to see the slowdown, and that could happen this quarter. It could happen next quarter. And then the other thing that I look out to when I say, okay, what could also stop this train is a lot of investors got nervous in April. A lot of investors sold stocks in April. They likely have big gains, and there's going to be, they might even be sitting on even larger gains. And the question is, do we see one of these tax selling periods at the end of the year as people look to, sell losses? Do they delay any gains that they might maybe want to sell to the next year? I think, if you look back, we've seen this before where we've had those big losses mid-year. So you think like I think it was 2015, 2016, we had one of these where we saw January, the year opened up and we just sold out of the gate, where people sold the winners because they were waiting. They thought they were overvalued. So I look to that. I think that could be the spark could be tax loss related, perhaps as early as January.
If they sold in April when they saw that they took gains then, then wouldn't they be selling the losses?
We'll be selling the losses. So we'll see, and you're starting to see that, right? So typically if you expect this effect to happen, you will see the stocks that are down start drifting harder. Right, yeah. And we've started seeing that. It's already started. Now, the mutual funds, which are a smaller player in the market, they have their tax year in the end of October. So we're seeing them start to trim and start to sell the losers. And then you're seeing the winners just kind of continue to go. So if we see that through the end of the year, that's probably a good indication that we might see tax loss selling in January.
Right. So this year, the ones that are probably the more value stocks would be to continue to sell. The only thing they have a loss in, and then wait to sell. The tech correction wouldn't occur to the first quarter next year.
So NVIDIA will be the canary in the coal mine. And if I hear you correctly, those stocks that are down might get some heavy tax loss selling. In January, we could potentially see a lot of those high flyers, people beginning to trim and seeing some pressure. We've got a couple minutes left. I'd love to get your insight on just broadly from both of you, and literally you get like 2 minutes on this, Tyler. So where do you see the broad economy in 2026? Tyler, you go first, then Tom, you get to wrap us up.
The economic cycle moves in quarters, and what we're seeing right now is, and we began seeing it really the fall of last year, where we started, the pace of acceleration started slowing. Now we're starting to see outright deceleration in some of the economic figures, particularly through the course of the summer. Whether it's jobs, we're now getting negative jobs prints. We've seen large revisions to jobs. We've seen some of the non-headline economic data is flashing, frankly, warnings on the economy. So as that usually takes quarters to play through, I would not be surprised just from an economic perspective, GDP perspective, that we're looking at a very slow, to even potentially having, I'm going to say the recession word, at some point called, and that could take us well into the beginning of next year.
Okay, Tom, what say you?
I agree with a lot of that. I mean, we're starting to see manufacturing's been right at the PMI, I think right around 50, so which is barely growth. We're seeing a drop in jobs. ADP number came in really low. We see a lot of negative revisions. I think we are getting high retail sales on the high end. We're also seeing some pressure on the high end. They're buying, God bless the American consumer, but they're also a higher percentage of those are falling behind in their credit card payments. So we're seeing some weakness in home buying. So I think which has been strength of the economy. So I mean, I think we have a lot of momentum and probably go through the end of the year. Next year, I do think we'll see earnings will start to deteriorate, and when we may, especially in the tech sector, and we may see that rotation next year.
Okay, so if I hear you correctly, momentum will carry us until it doesn't, and there's great insight, and then. Traditionally, when the bubble bursts, it's impactful.
Well, the market went down 15% in March 2000, then rallied back again, and then really was the second leg drop that really was the brutal one. The buy on the dip has worked really well for a couple of years. I don't know it's going to work this time. If we have that dip in the first quarter next year, it may not be the time to buy in.
Well, but all the new investors buying on the dip has worked each and every time.
They've worked really well.
So
it works well.
It works until it doesn't.
Right.
Well, I think that's a wrap. Tyler, thanks for joining us. Tom, thanks for your insight.
Our optimistic tone.
Well, Dr. Doom was not as...
Well, I'm Dr. Doom Jr.
Yeah, between the two of you. So I'm going to probably have to have a cocktail tonight. Thanks for joining us. Hope you were able to get some insightful, actionable ideas. We have thought leadership here, and we love bringing it to you. We hope to see you on future editions of Quarter Over Quarter. If you like this, please thumbs up, subscribe, share it with your friends, and we look forward to seeing you on future editions.